Ever felt like financial statements are written in, I don't know, a secret language?
Yeah.
Where terms like amortized cost and fair value through other comprehensive income sound like they belong in a spell book.
Absolutely. It can be intimidating.
Well, today, we're trying to give you a decoder ring for one of the most fundamental areas of corporate finance, IFRS 9 financial instruments.
That's the plan.
Our mission in this deep dive is to take comprehensive articles, some really specific real-world examples about IFRS 9, and just pull out the most important bits of knowledge.
Yeah, cut through the jargon.
The goal is to give you a shortcut, really, to understanding how companies recognize, measure, manage their financial assets and liabilities, and maybe more importantly, why it's so crucial for understanding their true financial health.
And it truly is crucial. I mean, IFRS 9 is basically the updated GPS for how companies present their financial picture.
Good analogy.
Especially now, with volatile markets, complex deals. It's everywhere. We're going to try and simplify these rules, show you not just what they are, but why they actually matter, why they change how you should look at a company's financials.
Okay, let's unpack this then. Before a company can do anything else with a financial asset or liability, it has to actually acknowledge it exists, right? Put it on the books.
Exactly. Recognition.
So when does that happen? What's the trigger?
The core principle is pretty straightforward, really. A company recognizes a financial asset or liability the moment it officially becomes a party to the contractual provisions of that instrument.
Okay, so when it becomes a party to the contract, like legally bound.
Precisely. When it's locked in, think about a firm order for goods a customer places.
Yeah.
The company wouldn't recognize that as a trade receivable right away. They wait until at least one side has performed, usually when the goods are shipped, maybe delivered. But contrast that with something like a forward contract or an option. If that falls under IFRS 9, it gets recognized on the commitment date itself, right when the contract is formed, because the rights and obligations kick in immediately.
Got it. And when they first put it on the books, how's it valued? Is it just the cost?
Generally, it's valued at its fair value.
Fair value. So market price, basically.
Yeah, think of it as the price you'd pay to buy it or receive to sell it in an orderly transaction today.
Yeah.
But there's a little twist with transaction costs.
Oh.
How those costs are treated depends entirely on which measurement category the instrument ends up in later. It's not, one size fits all.
Right. Okay, so once it's officially on the books at fair value, more or less, how do companies measure these financial assets going forward? I know IFRS 9 brought in these main categories.
That's right. 3 main buckets for financial assets. You've got fair value through profit or loss, FVTPL we usually call it.
Okay.
Then amortized cost, and fair value through other comprehensive income, or FVOCI.
FVTPL, amortized cost, FVOCI.
Got it. And companies don't just pick one, right? You said it depends on specific things.
Exactly. Classification isn't arbitrary at all. It hinges on 2 key pillars.
Okay, what are they?
First, the company's business model.
Business model.
Yeah.
What does IFRS 9 mean by that exactly? Is it just their overall strategy?
It's more specific than that. It's how the entity manages its financial assets to generate cash flows. Is the main goal to hold the asset and collect the payments over time?
Okay, hold to collect.
Or is it mainly about selling the asset? Or maybe it's a mix of both. It's described, as a matter of fact, how they actually operate, not just what they say they do.
Right, based on reality. And the second pillar?
The second is the contractual cash flow characteristics. This sounds technical, but the idea is simple.
Okay.
The cash flows from the asset must be solely payments of principal and interest on the principal amount outstanding. We often call this the SPPI test.
SPPI, solely payments of principal and interest. Exactly. Think of a basic loan or a simple bond. You get your original amount back plus a standard interest charge. No weird formulas, no payouts linked to, say, share prices or commodity prices, just plain vanilla principal and interest.
That distinction makes a lot of sense. So if a company's business model is basically hold to collect those simple SPPI cash flows,
then it generally gets measured at amortized cost.
and that's probably pretty common for things like loans and receivables.
It often is, yes. Now, for FVOCI, the cash flows still need to pass that SPPI test. Simple principal and interest only.
Okay, same SPPI requirement.
But the business model for FVOCI is different. It's achieved by both collecting those contractual cash flows and potentially selling the asset.
So they might hold it, might collect, but they also might sell if the price is right.
Exactly. That's FVOCI territory. And there's also a special choice, an irrevocable election companies can make right at the start for certain equity investments, like shares in another company.
Oh.
If they're not holding those shares for active trading, they can choose to mention them at FVOCI. But once they choose, they can't change their mind.
Okay, interesting. And then you mentioned FVTPL. Sometimes an asset goes there even if it doesn't seem to fit the other two. Why would they do that?
Ah, yes, the fair value option. This is where IFRS 9 tries to prevent, let's say, misleading results. A company can choose, irrevocably again, to designate an asset at FVTPL right at the beginning if doing that gets rid of or significantly cuts down on what's called an accounting mismatch.
Accounting mismatch. Okay, break that down.
Imagine you own a rental property.
Right.
And you measure its value based on current market prices, right? It goes up and down.
Makes sense.
But the mortgage you have on that property is measured differently, maybe just based on the outstanding loan balance, which changes slowly. If you put those two things together on your personal balance sheet, the net picture might look really volatile or just weird because they're measured inconsistently.
Right. One's bouncing around, the other's stable.
Exactly. An accounting mismatch is basically that same problem inside a company-related assets and liabilities being measured on different bases, distorting the real economic link. This option lets them align the measurement, usually by putting both sides at fair value.
Okay, that makes sense. It stops the accounting rules from creating a confusing picture. Let's make this concrete. Here's where it gets really interesting. Let's look at DesignCo's intercompany loan. This feels like something lots of companies do.
Okay, DesignCo. They loaned $9 million to a subsidiary. But here's the catch. No formal agreement, no fixed repayment date, no interest charged.
Sounds informal.
Very. But there was an expectation it would be repaid on demand. And that had happened before. At year-end, the subsidiary couldn't pay it back immediately, but repayment looked probable a couple of months later. So the big question, can this be measured at amortized cost under IFRS 9?
My first reaction, and probably yours too listening, is no way, no interest, no fixed date. That doesn't sound like SPPI. It feels too casual.
That's the common assumption. But IFRS 9 can surprise you. It really digs into the economic substance.
Okay, so how does it apply here?
For the SPPI test, remember, it's solely payments of principal and interest, consistent with normal lending. Because this loan could be called at any time, you could argue that a bank might charge very low or even zero interest for a true on-demand facility, especially between related parties.
Okay. So the lack of interest isn't automatically disqualifying if it makes sense in context.
Exactly. You could argue it's not fundamentally inconsistent with a normal lending setup. So maybe does pass the SPPI test and the business model. Well, DesignCo clearly wasn't holding this loan to trade it. They were holding it to get the cash back.
Hold to collect.
Right. So believe it or not, the conclusion was that this intercompany loan met both IFRS 9 tests for amortized cost.
Wow. That really shows you need to look beyond just the paperwork. Substance over form.
Absolutely. A key theme in IFRS 9.
Fascinating. Okay, we've gone deep on assets. What about the other side, liabilities? Is it just as complicated or is it maybe a bit simpler?
You know, it generally is simpler. Most financial liabilities, they end up at amortized cost.
Okay.
You record the liability and the interest expense just flows through profit or loss. Pretty standard.
But there must be exceptions.
Oh, definitely. Financial liabilities held for trading sync derivatives again, or bonds a company issues specifically to trade actively. Those are always measured at FVTPL, fair value through profit or loss.
Okay, trading stuff is FVTPL. Makes sense.
And just like with assets, a company can choose to designate a liability at FVTPL right at the start.
Ah, that fair value option again.
Exactly. Same reason. To eliminate or significantly reduce an accounting mismatch.
Right. And this is where it gets kind of weird, isn't it? A company's own creditworthiness affecting the value of its own debt.
It does sound counterintuitive. But think about it. If a company starts looking shaky, its bonds might trade lower in the market because they're riskier, right?
Yeah, makes sense. Less likely to get paid back fully.
So the fair value of that liability actually goes down. Now, IFRS 9 stops companies from booking a profit just because their own credit rating tanked. That would be misleading.
Definitely.
So if a liability is measured at FVTPL, any change in its fair value that's purely down to changes in the company's own credit risk, that gain or loss goes to other comprehensive income, OCI.
Ah, it's siloed off in OCI.
Right. It doesn't pollute the main profit or loss figure. It keeps the operating performance clear, unless, again, putting it in OCI would itself create or worsen an accounting mismatch. Then it might go to P&L.
This raises an important question, though. When can a company actually use that fair value option for a liability? Give us a concrete case where that mismatch is bad enough.
Okay, let's look at Insert Co. They had an investment property like an office building they rent out. Under a different standard, IAS 40, they measured this property at fair value. Its value went up and down with the market.
Okay, property at fair value.
But they also had a financial liability, maybe a mortgage, directly linked to that property. Without the fair value option, the property's value is bouncing around, but the mortgage would likely be at amortized cost, barely moving.
There's the mismatch again.
Exactly. You've got the asset at current value, the liability at historical-ish cost. It creates noise. But because there's often a strong link, maybe both the property value and the liability are sensitive to interest rate changes, IFRS 9 lets Insert Co. use the fair value option for the liability too.
So both the asset and the liability move more in sync on the balance sheet.
Precisely. It gives a much truer, more aligned picture of that specific investment and its funding.
Okay, got it. Now let's talk about when things leave the books entirely. Derecognition. How do assets and liabilities disappear from the balance sheet?
Derecognition is just that, removing an asset or liability. For financial assets, it can happen simply because the contract ends, the loan is repaid, the rights expire.
Makes sense.
Or it happens when the asset is transferred in a way that qualifies. This means either the company literally hands over the rights to receive the cash flows.
Sells the receivable, for instance?
Exactly. Or, a bit more complexly, they might keep the legal right to the cash flows, but take on an obligation to pass those exact cash flows straight through to someone else. The key question is always, have they substantially transferred the risks and rewards of ownership?
Risks and rewards, like who benefits if it goes up in value, who loses if it goes down, or the borrower defaults.
That's the heart of it. If they haven't substantially transferred those risks and rewards, or if they've kept it control, they might still have to recognize the asset, at least partly what they call continuing involvement. Any gain or loss on a clean derecognition usually hits profit or loss.
Okay, and for liabilities, is it just when you pay them off?
Pretty much. Liabilities are derecognized when the obligation is discharged, paid, canceled, or it simply expires. But there's a really important concept here, substantial modification.
Substantial modification, what's that?
If you have an existing loan, and you and the lender agree to change the terms so much that they're basically completely different.
Like changing the interest rate massively or the repayment date?
Exactly. Or if you swap one debt instrument for another with very different terms.
Yeah.
IFRS 9 treats this as if you extinguished the old liability and took out a brand new one.
So it's not just tweaking the existing loan, it's treated as a whole new deal.
If the change is substantially different, yes. And IFRS 9 gives a clear rule for this, the 10% test.
The 10% test.
You calculate the present value of the cash flows under the new terms using the original loan's interest rate. If that present value is at least 10% different, higher or lower from the present value of the remaining cash flows of the original liability,
then substantial.
Then it's substantial. It's a bright line test. Very clear.
So what does this mean for a company that, say, renegotiates its loans? Let's look at ViewCo.
All right, ViewCo modified the terms of its long-term loans. Maybe they got better interest rates or longer repayment terms. The result was that the present value of the remaining loan payments, calculated using that original interest rate, dropped by 25%.
Okay, 25%. That's definitely more than 10%.
Absolutely. So applying the 10% test, it's clearly substantially different.
So what happens on their books?
The original liabilities have to be derecognized, wiped off, and new financial liabilities are recognized at their current fair value.
Kind of difference between the old book value and the new fair value.
That difference hits profit or loss, usually in the financing category. It's like they paid off the old loan, maybe recording a gain if the new fair value is lower, and immediately took out a new one. Then, going forward, they account for the new loan at amortized cost using its new effective interest rate, unless that fair value option applies.
Got it. A clean slate, essentially, with a P&L impact upfront. Okay, so if an asset starts in one category, say amortized cost, is it stuck there forever? Can companies change the measurement category later on?
Yes, they can, but it's rare. Reclassification is only allowed when a company changes its fundamental business model for managing those financial assets.
Only for a business model change, not just because they feel like it.
Definitely, not just because they feel like it. It has to be a significant strategic shift. Think about a bank deciding it's no longer going to hold loans to maturity, but will now actively trade them all. That's the kind of major change we're talking about.
And when that happens, how does the accounting work? Do they restate past results?
No, that's important. Reclassification is applied prospectively from the date of the change onwards.
Yeah.
You don't go back and rewrite history, no restating past gains, losses, or interest.
Okay, forward-looking only. Are there any assets that can never be reclassified?
Yes. Those assets the company chose to designate at FVTPL using the fair value option, they're locked in. And those equity investments where they made that irrevocable choice for FVOCI, also locked in. No reclassification allowed for those.
And liabilities, can they be reclassified?
Nope, never. Financial liabilities are never reclassified. Once their category is set, it's set.
Yeah.
That's a firm rule.
Okay, good to know. Let's shift gears again. Let's talk about the risk that assets might lose value because borrowers can't pay. Impairment. This feels like a big one under IFRS 9.
It is. It was one of the major changes from the old rules. Financial assets measured at amortized cost, or FVOCI basically. Most loans and debt investments have to be tested for impairment at every reported date. Equity instruments are generally exempt from this specific impairment model, though.
Every reporting date. Wow. And how does it work?
IFRS 9 uses a forward-looking model based on expected credit losses, or ECL. This is key. It's not about waiting for a loss to happen. It's about expecting losses in the future.
Expected credit losses, ECL.
Right. And the general approach distinguishes between 12-month ECL and lifetime ECL.
Okay, what's the difference?
ECL itself is the present value of all the cash shortfalls the company expects over the asset's life. It's probability weighted, considers different scenarios, the time value of money, and all reasonable, supportable information. It's trying to be an unbiased estimate of future losses.
So it's quite sophisticated. How do they choose between 12-month and lifetime?
That's the crucial judgment call. It depends on whether the credit risk of the borrower has significantly increased since the asset was first recognized.
Significantly increased.
If the risk has not significantly increased, the company only needs to recognize 12-month ECL. That's basically the expected loss from defaults that could happen within the next year. It's like an early warning.
Right.
But if the credit risk has significantly increased, then the company has to recognize lifetime ECL. That's the expected loss from all possible defaults over the entire remaining life of the asset.
That sounds like it could be a much bigger number.
It often is. And making that significant increase judgment requires looking at all sorts of information: past due status, credit rating changes, forward-looking economic data.
Sounds subjective.
It involves significant judgment, yes. But there are some helpers.
Mm-hmm.
There's a practical expedient. If an asset has low credit risk at the reporting date, you can generally assume its risk hasn't increased significantly.
Okay.
And for things like trade receivables or contract assets, there's often a simplified approach where companies can just recognize lifetime ECL from day one without tracking changes in credit risk for every single invoice. Makes life easier.
Right. So how does this loss allowance actually affect the financial statements?
For assets at amortized cost, the loss allowance directly reduces the carrying amount on the balance sheet. You see the net amount. And the change in the allowance during the period hits profit or loss, usually as an impairment expense or credit.
Okay, direct hit to P&L and the asset value. What about FVOCI assets? They're already at fair value.
Good point. For FVOCI debt instruments, the carrying amount on the balance sheet stays at fair value, but the ECL is still calculated, and the change in that ECL is recognized in profit or loss. To make the accounting balance, a corresponding adjustment is made in OCI. So the P&L impact is the same, but the balance sheet presentation is different.
Got it. P&L impact is key for both. Let's make this real again. How does a company react to bad news? Tell us about SBR and those PIPITCO bonds.
Okay. SBR buys $10 million of bonds from PIPITCO on January 1st, 20x7. They measure them at amortized cost. Initially, PIPIT looks fine, credit risk is low, so SBR recognizes no loss allowance. Standard stuff.
Right.
Fast forward to December 31st. SBR gets its interest payment, but then news breaks. PIPITCO is in serious financial trouble. The bond price drops sharply, even though the overall market is doing okay.
Red flags everywhere.
Exactly. SBR calculates the 12-month ECL at $1.6 million, but the lifetime ECL is way higher, $4.5 million.
Yeah. So, given all that bad news, the financial difficulties, the price drop, which ECL figure do they have to use? Has the risk significantly increased?
Oh, absolutely. This is a textbook example of a significant increase in credit risk. All the signs point that way.
So they have to use
lifetime ECL, the full $4.5 million.
And the impact on SBR's books?
Immediate and significant.
Yeah.
They recognize a loss allowance of $4.5 million. This reduces the net carrying amount of the bond asset on their balance sheet from $10 million down to $5.5 million. And there's a corresponding $4.5 million charge straight to profit or loss for the year.
Ouch. That really shows how IFRS 9 forces companies to face potential losses much earlier.
Precisely. It's about reflecting the economic reality of the increased risk today, not waiting for the actual default.
Okay, now let's move on to some tools companies use to manage these future risks. Derivatives. They sound complex, maybe even scary, but they're used all the time, aren't they?
They really are. And they can be complex, but the basic idea is straightforward. IFRS 9 defines a derivative as a contract whose value changes based on some underlying item like interest rates, commodity prices, exchange rates.
Right.
It typically requires little or no initial investment compared to buying the underlying item itself, and it's settled at a future date.
Give us a simple example.
Think of a bread maker worried about the price of wheat going up. They could buy a wheat futures contract today, locking in a price to buy wheat in, say, 6 months.
Okay, hedging their costs.
Exactly.
Yeah.
If wheat prices shoot up, the futures contract becomes valuable, offsetting the higher cost of actual wheat. If prices fall, they lose on the contract, but hey, they get cheaper wheat. Often these are settled net in cash without any physical wheat changing hands.
Right. And the general rule for accounting for derivatives?
The default rule is all derivatives are measured at fair value, and any changes in that fair value go straight into profit or loss.
Okay, so potentially volatile P&L impact.
Yes, unless they qualify for special hedge accounting, which we'll get to. But there's a really important carve-out first.
An exception. So not every contract that looks like a derivative is treated as one.
Exactly. This trips people up. A contract might meet the definition its value changes, settled later, little initial cost. But if it was entered into and continues to be held for the purpose of receiving a non-financial item.
Like actual wheat or oil or electricity.
Yes, and it's in line with the company's expected usage requirements, meaning they plan to actually take delivery and use it in their business, not just trade the contract.
Right.
Then it's not accounted for as a financial instrument under IFRS 9, even if it looks like a derivative. It falls outside the scope.
Okay, let's test this with InsertCo's fuel forward contract. They locked in a price to buy fuel.
Right. Interco contracted to buy fuel for heating their office.
Yeah.
Key points. Physical delivery was required. They intended to use it themselves, not resell it. It couldn't be settled net in cash, and there was a penalty if they didn't take delivery.
So is this a derivative under IFRS 9? Its value definitely changes with the fuel price.
Good question. It looks like one. But remember the exception. IFRS 9 applies to contracts for non-financial items if they can be settled net in cash or by swapping financial instruments. But there's that specific carve-out for contracts entered into for the entity's own expected purchase, sale, or usage requirements.
And InsertCo intended to use the fuel.
Correct. Since the fuel was for physical use in their operations, couldn't be net settled, and met the own use criteria, IFRS 9 does not apply here.
So how is it accounted for?
The fuel purchase itself would likely just be treated under inventory rules, IAS 2, when it happens. Not as a financial instrument creating P&L volatility beforehand. It shows you have to look at the purpose and the settlement mechanism, not just the form.
Okay, that's a crucial distinction. Own use exemption. Now let's get into the really advanced stuff. Hedge accounting. You mentioned it's optional.
Yes, it's an optional overlay. Companies don't have to apply it, but it's incredibly useful.
Why? What does it do?
Basically, it lets companies align the accounting results with their actual risk management strategy. Remember how derivatives usually hit P&L based on fair value changes?
Yeah, causing potential volatility.
Well, the thing you're hedging may be future sales in a foreign currency, or the value of existing inventory might be accounted for differently or not impact P&L until later. This creates another accounting mismatch. Hedge accounting fixes this by allowing you to match the timing of the gains or losses on the hedging instrument, the derivative, with the gains or losses on the item being hedged.
So it smooths out the P&L, makes it reflect the net result of the hedging activity.
Exactly. It reduces that artificial volatility and gives a clearer picture of performance. There are two main types.
Okay.
First is a fair value hedge. This hedges the exposure to changes in the fair value of something already on your books, like a fixed rate loan you hold or inventory, or even an unrecognized firm commitment to buy something at a fixed price.
Okay. Hedging existing fair value risk. And the other?
The other main type is a cash flow hedge. This hedges exposure to variability in future cash flows. Think about future sales in a foreign currency, future purchases of raw materials at variable prices, or the interest payments on variable rate debt. or, importantly, a highly probable forecast transaction.
Highly probable forecast transaction.
Yeah.
What does that mean exactly? How sure do you have to be?
It means it's got to be very likely to happen, not just a vague plan or a hope. There should be solid evidence, maybe agreements in principle, board approvals, historical patterns. It needs to be near certain, but just hasn't occurred yet.
Okay. And to actually use this special hedge accounting, companies have to jump through some hoops, right?
Oh, yes. Strict criteria. The hedge relationship must involve eligible instruments and eligible hedged items. There has to be formal designation and documentation right at the start. You can't decide later, oh, let's call that a hedge.
Gotta plan ahead.
Definitely. The documentation needs to outline the risk management strategy, the objective, how effectiveness will be tested. And speaking of effectiveness, the hedge needs to meet specific criteria there too.
Like what?
There must be an economic relationship between the hedged item and the hedging instrument. They should generally move in opposite directions. Credit risk shouldn't dominate the value changes. And the hedge ratio, the amount of hedging instrument used versus the amount of hedged item, must be consistent with the company's actual strategy.
And if it stops being effective?
If the ratio gets out of whack, sometimes they can rebalance it, adjust the quantities to keep hedge accounting going. But if the hedge just stops working effectively or the criteria aren't met, hedge accounting have to stop.
So what happens when the world changes? When those highly probable future deals suddenly look less probable? Let's talk about Mailings Co.
Right, Mailings Co. They had cash flow hedges set up for highly probable future raw material purchases and future sales. But then the economy went sour. They stopped buying materials and customers weren't buying as much.
So that highly probable status is now questionable.
Exactly. If those future transactions are no longer considered highly probable, they can't be hedged items in a cash flow hedge anymore. Hedge accounting for them must stop.
Okay, stop hedge accounting. What happens to the gains or losses already built up on the hedging derivatives? They were probably sitting in OCI, right?
Correct. And what happens next depends on whether the transaction is still expected to occur or not. This is a critical split.
Okay.
If the transaction is no longer highly probable, but the company still expects it to happen eventually, maybe just delayed, then hedge accounting stops, but the accumulated gain or loss stays frozen in OCI. It just sits there until the transaction finally occurs.
Okay, deferred in OCI. But what if the deal is off completely?
That's the key difference. If the forecast transaction is no longer expected to occur at all, it's canceled, the project scrapped, then any gain or loss on the hedge sitting in OCI has to be immediately reclassified or recycled straight into profit or loss.
Boom, hits the income statement right away.
Right then and there. It reflects the fact that the hedge is no longer offsetting anything real.
That's a really important distinction. Delayed versus canceled. Okay, let's try and tie this all together. A full example. Cash flow hedge, step by step. Review Co. and their foreign exchange hedge. This can feel complicated, so walk us through it slowly.
Okay, Review Co. They expect to receive 3 million dinars on January 31st, 20x8 from selling goods. They're worried the dinar will weaken against their home currency, say the dollar.
Classic foreign exchange risk.
Exactly. So on November 1st, 20x7, they enter into a forward currency contract to sell 3 million dinars on Jan 31st at a fixed rate. They designate this as a cash flow hedge of that future dinar receipt. They document it all, assess it as effective.
Okay, hedge setup. What happens at their year-end, December 31st?
At discovery first, let's say the forward contract itself has increased in value. It has a positive fair value of $100,000. This means the dinar has weakened, so their hedge is working.
Good news for the hedge.
Yes. Now they compare this to the change in the value of the expected future cash flow. Let's say that future dinar receipt is now worth $98,000 less in dollar terms than they originally expected.
Okay, the underlying exposure lost value.
Right, so the effective portion of the hedge gain is the $98,000 that perfectly offsets the loss on the forecast transaction. That $98,000 goes into OCI, into the cash flow hedge reserve in equity. It waits there.
And the extra $2,000 gain on the contract, $100K gain versus $98K offset needed.
That $2,000 is hedge ineffectiveness. It doesn't match a loss on the hedged item. So that $2,000 goes directly to profit or loss for the year, probably in the operating category.
Okay. Effective part to OCI, ineffective part to P&L. Got it so far. Now, fast forward to January 31st, when they actually get the dinars and settle the contract.
Right. On Jan 31st, let's say the forward contract's fair value increases by another $4,000. So its total positive fair value is now $104,000. And let's assume at this point the hedge is perfectly effective. The cumulative change in the contract perfectly matches the cumulative change in the value of the dinar receipt.
Okay, so it became fully effective by the end.
Yes. So we need to adjust OCI. The cumulative effective gain is now $104,000. To get the OCI balance up to $104K, we'd put the additional $6K, 4K current gain, plus reversing the $2K ineffectiveness previously in P&L through OCI. We'd also make an opposite $2K entry to P&L to reverse out the ineffectiveness recognized earlier now that the hedge is fully effective overall.
Bit tricky, but okay. OCI now holds the full 104K effective gain. What happens when they get the cash?
When ReviewCo actually receives the 3 million dinars from their customer and settles the forward contract, receiving $104,000 cash from it, the really crucial step happens. That entire $104,000 cumulative gain that was sitting patiently in OCI, it's recycled. Reclassified from OCI directly into profit or loss in the same period and same line item, likely revenue or cost of sales, affected by the original hedge transaction, the sale.
So the hedging gain hits P&L at the exact same time as the impact of the lower dinar value on the sale itself.
Exactly. That's the whole point of cash flow hedge accounting. It matches the timing. The gain on the hedge, 104K, offsets the implicit loss from the weaker dinars received on the sale, giving you a net result in P&L that reflects the originally intended dollar amount of the sale, smoothed out from currency fluctuations.
Wow. Okay, seeing the full cycle makes it click. That recycling from OCI to P&L is key. We've covered a lot of ground there, an extensive journey through IFRS 9.
We certainly have.
From recognition, measurement, derecognition, impairment, derivatives, hedge accounting. It really underscores how vital understanding these rules is if you want to truly interpret a company's financial story.
Absolutely. And you see the themes. IFRS 9 pushes for more forward-looking information, especially with ECL.
Yeah, the expected losses.
And more transparency about risk management through the hedge accounting rules, that highly probable test. It's trying to get beyond just historical cost and show the real economic exposures and how companies are managing them.
So what does this all mean for you, listening? Well, the next time you look at a company's financial report, hopefully you have a deeper understanding of what's going on beneath the surface.
Yeah, look beyond the headline numbers.
Think about, how are they classifying their assets? Is it mostly amortized cost or lots of fair value stuff? Are there hints of accounting mismatches they're using the fair value option to fix? How are they tackling credit risk? Are they recognizing significant expected losses?
Good questions to ask.
And if they use derivatives, are they getting hedge accounting treatment? Or are those derivatives just adding volatility to the bottom line? These aren't just numbers. They really are reflections of strategy, risk appetite, management choices. What other hidden stories might be lurking in those IFRS 9 disclosures?
Exactly. IFRS 9, complex as it can be, provides some powerful tools for analysis. It really encourages you to think critically about how well the financial statements reflect the underlying economic reality and the risks the company faces.